Hello guys, very beautiful greetings of the day to all of you. Here, I Kunal Nagpal feel divine pleasure to welcome you guys once again to this great economic podium. Dear guys, today we are basically going to have a deep dive in the core analytics of the Indian economy with regard to the global earthquake happening in the entire global economy and what are the after effects of that particular disaster on the Indian economy and how is India preparing itself very well in order to minimize the number of losses and in order to maximize its strengths and the overall productivity so that it can strategize a very beautiful framework for governing the country. So here it goes. And like always, we will begin our session with a certain philosophical content which really charges us to the fullest in order to absorb the content, the content of the session with great effectiveness. So here it goes. Let's discuss the story or an incident or an interactive session between the two ants. One is the jolly good ant and another is not so jolly ant. So once an ant that was living in a mountain of sugar met another ant living in a mountain of salt and asked, "Hello, my dear friend, how do you do?" It replied, "I am not as jolly as you are. My mouth is always saltish as I am living in a mountain of salt." The jolly ant said, "Come along now to my abode. I shall make you jolly. I live in a huge mountain of sugar. I shall make your tongue always sweet." The unhappy ant followed the jolly ant to the mountain of sugar and lived there for a week. Now, the jolly ant asked his friend, "How do you fare now, my amiable comrade?" It replied, "Still the same as my lot, my good friend." What now? The jolly ant said, "Wash your mouth well with this saccharine solution. Rub your tongue well with this sugar soap. Your tongue needs good brushing up. You were living for several years in a mountain of salt." It followed the instructions of the jolly ant. From the 8th day, its mouth became sweet finally. It also became very, very jolly. Some aspirants keep within themselves some hidden desires, that is the subtle desires, greed, moh and pride. These doshas cling into their minds just as the old salt dung to the tongue of the miserable ant. Rub your mind and the heart with the soap of jap and selfless service. Eradicate all the desires and impurities of the mind. You will enjoy the supreme bliss of Paramatman. That's the real essence of attaining the true victory, of attaining the true essence of self-realization, which ultimately leads to God realization. And that's all we aspire for. That is attaining the contentment, attaining the state of complete bliss, complete supremacy. And that's truly divine. And yes, all of us are capable of doing that. So I really hope that this story of the jolly good ant and unhappy ant made you very, very jolly, because I hope it must have helped you to explore the hidden treasures within yourselves. You may take it as an inspiration and try to implement the same thing on yourselves as well. Now, my dear guys, on this note, I would like to come back to the homework I gave to you last night. That is, why India should host 2036 Olympics. You had to ponder upon this particular topic, introspect, then count some strengths of the Indian economy, which will enable it to host 2036 Olympics. Now let's see. India's plan to make a bid to host the Olympics in 2036 not only makes eminent sense, but it should be pursued with Olympian enthusiasm and planning. The two not always coming in one automatic package. This is no fuzzy wish for an inspirational and aspirational world power. India will be in contention as a host for the 2036 Olympics with the likes of Qatar, that is freshly having tasted the success at this year's Football World Cup host despite much controversy leading up to the tournament, South Korea and Indonesia. If India finally showed potential for its still underperforming athletic prowess last year in Japan, hosting a world sporting event requires, as Qatar showed, a different set of skills, enterprise, and dedication. But apart from the prestige of holding the Olympics 13 years from now, what makes such a bid worthwhile? Target-based infrastructural development, whether the 1982 Asian Games or the 2010 Commonwealth Games, both of which provided that developmental push for Delhi, can be a great catalyst actually, the effects of which become permanent long after the actual event is over. And if Indian economic growth, despite the current globally induced unsteadiness, is anything to go by, Citius, Altius, Fortius, faster, higher, stronger, is not just a rallying cry confined to the Olympics, but to the public life of a nation beyond. India, according to the likes of the Center for Economics and Business Research, that is CEBR, is actually slated to become the world's third $10 trillion economy by 2035. To answer the spoil sports decrying whether a country like India, with its legacy socio-economic challenges yet to be resolved, should waste time and money on it. The very challenge of hosting an Olympics can also be a cause for, and not just for, an effect of the sustained wealth creation. Now, my dear friends, these are actually some challenging questions which we must answer to the people with time. That is, India, according to the likes of the CEBR, is slated to become the world's third $10 trillion economy in 2035. To answer the spoil sports decrying whether a country like India, with its legacy socio-economic challenges yet to be resolved, should waste money on it. The very challenge of hosting an Olympics can also be a cause for sustained wealth creation. I hope many of you must have collected these particular points, right? So we are on a good track. Congratulations. Now, we are going to discuss a very, very important aspect of the Indian economy as of now. The current account deficit surges to record $36.4 billion in September quarter. India's second quarter current account deficit, or the excess of imports over exports, rose to its highest since the so-called taper tantrum of 2013 at 4.4% of the gross domestic product. But the central bank and the financial experts believe healthy economic underpinnings and robust foreign exchange reserves will help Asia's third biggest economy, withstand the external imbalances. New Delhi's current account balance recorded a deficit of $36.4 billion or 4.4% of the gross domestic product, that is the GDP, in the September quarter, up from $18.2 billion or 2.2% of the GDP in the first quarter. Data published by the Reserve Bank of India showed the deficit was at $9.7 billion or 1.3% of the GDP a year ago. Underlying the current account deficit was the widening of the merchandise trade deficit to $83.5 billion from $63 billion in the first quarter and an increase in the net outgo under investment income, the RBI said Thursday, that is 29th December 2022, in a statement. Our RBI governor, Mr. Shaktikant Das, is actually sanguine about India's ability to withstand the global shocks and external imbalances. Current account deficit, that is CAD, is eminently manageable, and let there not be any doubt about it, Mr. Das said earlier this month. The global trade is shrinking amid the COVID-related disruptions in China and monetary tightening by the central banks in the West as they struggle to retrain four-decade consumer inflation. This is taking a toll on the currencies across the board, more so in emerging markets, funding imports through capital flows. India is actually no exception, with oil imports climbing and exports slowing. But India's services sector is holding out, with software services leading from the front. With benign commodity prices, the outlook for India is set to improve in the coming quarters. A global slowdown serves as a double-edged sword for the external sector, said Ms. Sonal Verma of Nomura Securities. On one hand, the domestic slowdown and lower global commodity prices should result in lower imports. On the other, the current account would be under pressure from the lower exports and the capital account would face outflows. Nomura expects the deficit to narrow to 2.5% of the GDP from 2023 onwards, from 3% in 2022, but at nearly $100 billion, funding this deficit will require large debt and equity inflows. While there is a worry about the weakness of the Indian rupee, which slumped during the capital outflows when the Fed chairman, Mr. Ben Bernanke's taper tantrum in 2013, the macro factors appear to be more favorable now than what they were a decade ago. The rupee has in fact been an outperformer among the emerging market peers. India's current account deficit in the September quarter of 2012 was at 5.4% of the GDP, and Forex reserves were insufficient to fund imports and defend the exchange rate due to outflows. But the script is actually very different this time around. The story of Indian rupee is one of resilience and stability, said Mr. Das. I repeat, the story of Indian rupee is actually one of resilience and stability, said Mr. Das. We remain committed to act to prevent excessive volatility of our exchange rate. Our focus will continue to be on the orderly evolution of the exchange rate. The foreign exchange reserves have climbed to $563 billion now from $524.5 billion on October 21. But the emerging situation could actually pose a challenge to the central bank as the volatile capital flows and weakening services exports remain the potential risks. The services exports expanded 30.2% in the September quarter on year on the back of rising exports of software, business, and travel services. But the primary income account, mainly reflecting the payments of investment income, saw an outflow at $12 billion from $9.8 billion a year ago, the RBI data showed. Reflecting the tight global monetary conditions, external commercial borrowings, a key source of capital flows, saw an outflow of $400 million compared with an inflow of $4.3 billion a year ago. The reading reflected a wider trade deficit, but this will likely be the peak of the current account deficit this fiscal year as the commodity prices have eased, said Ms. Madhavi Arora, economist, MK Global Financial Services. Net investment income will continue to be a larger drag amid higher interest rates abroad, she said, forecasting a current account gap of 3.4% of GDP for the financial year 2023. Now, my dear friends, let's analyze the key highlights in detail. So the key concerns are: the current account deficit is at $36.4 billion or 4.4% of the GDP in the second quarter. The current account will remain under pressure due to lower exports. It stood at $18.2 billion or 2.2% of the GDP in the first quarter. Shrinking global trade amid COVID-led disruptions in China, monetary policy actions taking a toll on the global currencies. Capital account outflows expected ahead. Now, what is the silver lining? That is the resilience shown by the rupee. The Forex reserves at $563 billion now provide enough buffer. The services sector bucking the slowdown trend. So dear friends, this write-up is very well articulated as this gives us an in-depth analysis of the matter. Now, my dear friends, we are going to move ahead to analyze how India's manufacturing sector will drive the next phase of growth. According to Ms. Sonia Das Gupta, MD and CEO of Investment Banking JM Financial. Ms. Sonia Das Gupta, Managing Director and Chief Executive Officer of the Investment Banking JM Financial Limited, who has been an investment banker for more than 25 years, talks about where the Indian economy is headed and which sectors will witness more mergers and acquisitions in 2023. First question asked to her is, India has emerged as the fifth largest economy in the world. What are the factors which will drive the next phase of growth for the economy? To which she replies, Indian economy is actually better placed than any other economy globally. India's GDP growth is expected and is estimated to be in the range of 6.5 to 7%, and a current account deficit is expected to settle in the range of 3 to 3.2%. The capex cycle has also all the conditions needed to grow. India's manufacturing sector, in addition to the existing strong services sector, will drive the next phase of growth. The global companies have realized the need for a resilient supply chain. Although the exact form of deglobalization trend is uncertain at this stage, this shift would be major opportunity for India to capture the global manufacturing space. Fiscal efforts towards boosting manufacturing through its policy initiatives like PLI, PM Gati Shakti and National Logistics Policy would help India capture the global manufacturing space. We believe the government's strong capex, that is for both center and state, would spur private capex as the current manufacturing capacity utilization is at its highest in the last 3 years. That is 73.4%, 3 months moving average. In addition, the banking system is actually well poised to take care of the corporate credit demand thanks to the excess SLR, that is 17.5 trillion rupees, that is actually being carried by it. Hence, the conditions are conducive for a pickup in the private investments. Further, India's export basket is already reflecting a shift from low-skilled products to the high-skilled products, indicating that our economy is already rising up the value chain. So the coordinated fiscal measures in enhancing the quality of exports and identifying the new products and geographies would help broaden our export basket, including the services exports. Higher production would not only lead to higher exports and improved employment opportunities, but also would give a fillip to the private consumption, which is a major contributor, that is 61% to our GDP. The next question raised to her is the mergers and acquisition volumes are witnessing a steady uptick in 2022 thanks to the reasonable valuations. What are the sectors which will drive the growth going forward? To which she says, the reasonable valuation is a powerful trigger that motivates the companies to pursue inorganic growth opportunities. India witnessed a record number of mergers and acquisition deals in the year 2022 across all the sectors. So in YTD 22, the collective value of mergers and acquisitions deals in India amounts to nearly $152 billion compared to $107 billion in the year 2021. The domestic deals account for the bulk of the deals, that is 72% by value and 52% by volume. Rising interest rates and volatility in the equity capital markets are creating the M&A opportunities as over-leveraged companies and PE-funded companies are looking for an exit. M&As, that is the mergers and acquisitions, will also be driven by the consolidation theme across the sectors. Then the theme of divestiture of core assets which are actually no more core, and availability of stressed assets at attractive valuations through NCLT and government-led divestments. The trend of acquiring new technologies or brands in the healthcare or consumer space will also push M&A growth. The mergers and acquisitions driven by consolidation will gain scale in the sectors like healthcare, consumer and industrials, renewable energy and power. Sectors like financial services, technology, etc. will witness strong momentum in mergers and acquisitions as well. Now, India has outperformed China in Asia Pacific's PE-backed activity in 2022 in terms of volume. What are the factors that have reignited the interest of PE investors? India makes a strong case for investments given the growing investor concerns over China. India has emerged as a lucrative market for the private equity investors. In terms of deal value, private equity exits in financial year 2022 stood at $28.5 billion as compared to $10 billion in YTD financial year 2023 and in the financial year 2022, technology and financial services witnessed the highest activity in terms of technology, and power ancillary accounted for 26% and 19% of the total private equity exits in terms of value. So the factors that have contributed to this emergence have been political and economic stability in India, coupled with better governance framework and disclosures. Also, the diversity of fund sizes and types with an abundance of committed capital has also helped the investment scenario in India. So these are such favorable factors. And this has culminated into India pulling ahead of China when it comes to attracting the capital from global private equity funds that invest in Asia. Funds that used to typically allocate a larger share of capital to China have increased allocation and focus towards India over the past few years. This is reflected in the deal volume in India, which witnessed a rise of 3%, that is 9M 2022 versus 9M 2021, compared to a drop of 7% in China during the same period. Private equity investments typically shadow the public sectors. Historically, the overall capital harvested through exits enabled by buoyant public markets has culminated in subsequent spikes in the private equity investment activity. In terms of private equity exits, technology, financial services, and healthcare sectors 20% each in terms of value have contributed to the deal activity in India in 2022, with technology, that is 70% of the deal value, being the only dominant sector in China in 2022. Now, given the fall in India Inc.'s overseas borrowings, how do you view the corporate's outlook towards raising equity from the capital market? Actually, the external commercial borrowing has of late become less attractive thanks to an interesting rate increase in the overall interest rates by the central banks and the depreciation of the rupee against the US dollar. Fundraising from overseas sank to a 76-quarter low in the second quarter of the financial year 2023 to $210 million amid volatility in the currency markets, a sharp rise in interest rates in the US, and fund availability in India. The corporates have delivered their balance sheets over the last few years and therefore have some cushion to raise more debt. However, due to the extreme volatility witnessed in earnings, corporates will aim to keep a healthy mix of debt and equity. We thus expect the corporates to continue to actively raise funds through equity markets. Now, the next question raised to her is, the IPO market is actually becoming very busy and active again. How do you oversee and foresee the performance the IPO market will be performing in 2023? The IPO markets have been extremely buoyant over the last 2 years and investors have made money. Both global and domestic investors have become active in secondary markets, and we have witnessed this momentum building into the primary markets as well, thus giving us comfort that Indian markets will be able to absorb the deals. Now, as many as 90 companies are scheduled to launch their IPOs in 2023 and may raise around 1.4 lakh crore rupees by listing on the exchanges. The retail investors especially have a bigger role to play. Currently, there are 10.4 demat accounts from about less than 2 crore demat accounts a year ago. The retail investors holding the NSE listed universe is at a 15-year high of 9.7% as of March 2022. The primary market still has an appetite for the companies following regulatory and governance norms and those companies capable of delivering sustainable value. Having said that, some significant headwinds that would impact investors include expanding the trade deficits, foreign institutional investors' outflows, volatile currency fluctuations, and constricting liquidity conditions. Now, the final question raised to her is, what is your growth outlook for JM Financial Investment Banking business for the year ahead? So she replies, as we approach the year ahead, our deal and transaction pipeline spread across the industries and product segments look robust and quality driven. We believe, given the tailwinds of deal making in India, we will have a very busy 2023. So this very well articulated interactive session between the great pioneer leader, Miss. Sonia Das Gupta, MD and CEO of Investment Banking JM Financial Limited, is such an enriching one, right? So, this interactive session with her is such an enriching one. And we have gained great insights, helping us to broaden our overall perspective. Now, my dear friends, there is actually the new update which has come today evening. That is, India's Forex reserves also fall to $562.81 billion from $563.49 billion. India's Forex reserves fell to $562.81 billion as on December 23, 2022. The Reserve Bank of India said on Friday, that is, on 30th December 2022, India's Forex reserves stood at $563.499 billion as on December 16, 2022. The foreign currency assets stood at $498.5 billion. Now, FCA, the foreign currency assets, is actually a major component of the overall reserves. Expressed in dollar terms, the FCA includes the effect of appreciation or depreciation of the non-US units like euro, pound, and yen held in the foreign exchange reserves. The gold reserves stood at $40.97 billion and the SDR is at $18.2 billion. The reserve position at the IMF is at $5.2 billion. At the start of 2022, the overall Forex reserves were at $633.61 billion and dropped to a two-year low in October. Much of the decline can be attributed to the RBI's intervention and a rise in the cost of imported goods. It is still down sharply from a peak of over $642 billion touched in September last year. That's in 2021. Indian Forex reserves have come down probably due to some sales by the central bank, but the same can be actually replenished in case dollar supplies improve in 2023. Mr. Bhaskar Panda, HDFC Bank's Executive Vice President of Overseas Treasury, told news agency Reuters. So this is again a very insightful write-up providing us with the fresh updates of the fall in Forex reserves to $562.81 billion from $563.49 billion. So this is extremely useful for keeping us updated. Moreover, the infrastructure output rises 5.4% in November. India's 8 core industries recorded a growth of 5.4% in November as against 3.2% in the same month last year, that is 2021, according to the data released by the Ministry of Commerce and Industry on Friday, that's on 29 December. The cumulative growth rate of ICI during April to November 2022 stood at 8.0%, that is provisional, as compared to the corresponding period of the last year. The production of cement, coal, electricity, steel, and fertilizers increased in November 2022 over the corresponding month of the previous year. The production of crude oil, natural gas, and petroleum refinery sectors contracted by 1.1%, 0.7%, and 9.3% respectively. ICI measures combined and individual production performance is basically segregated in the selected 8 core industries, namely coal, crude oil, natural gas, refinery products, fertilizers, steel, cement, and electricity, the statement said. The 8 core industries comprise 40.27% of the weight of the items included in the Index of Industrial Production, that is IIP. Now, my dear guys, we are going to discuss another very important aspect, that is oil weakens on China uncertainty. Basically, oil prices fell by more than $1 on Thursday, that's on 28 December 2022, as more countries consider restrictions on Chinese travelers, raising concerns over the demand during uncertainty about COVID-19 infections spreading in China. Now, the conflicting headlines about demand from top oil importer China have buffered the traders in recent weeks. While China's government is actually dismantling the pandemic restrictions, a surge in infections there is prompting some countries to enact the travel rules on Chinese visitors. The Brent crude futures for February fell by $1.06 or 1.3% to $82.2 a barrel by 11:52 a.m. EST. The more actively traded March contract was drawn about 1.4%. The US West Texas Intermediate crude futures for February delivery were down $1.13 or 1.4% to $77.83 a barrel. Britain is reviewing whether to impose the restrictions on people arriving from China, while in the US, Japan, India, and Taiwan, there have already been the impositions to test on arrivals from the country, that is China. Both oil contracts dipped from more than 2% earlier in this session, but pared the losses as the US dollar slipped, with investors an edge at the end of year as initial optimism over China's reopening fizzled. A weaker dollar means oil cheaper for the holders of other currencies and can boost demand. So with so many moving parts, I don't think anyone can say anything with any strong degree of conviction. Mr. Craig Erlim, a senior market analyst at Oanda, said OPEC Plus could make an announcement at any point and suddenly everything changes. Not to mention Russia's war in Ukraine and how that develops. Russia basically fired scores of missiles into Ukraine early on Thursday, targeting Kyiv and other cities in one of Moscow's largest aerial assaults since the war started. Oil prices also gained some support over the inventories update for last week from the US Energy Information Administration. Despite a surprise build in the crude oil stocks, the report itself was positive, said Giovanni Stornovo of Swiss bank UBS, adding it showed a solid rebound in implied oil demand, resulting in the large draws of refined products last week. Now, this is an extremely in-depth analytical discussion which discusses and highlights the core intricacies of the oil industry in India, and we have discussed various international economical aspects related to this particular topic. Now, there's a great good news, that is 6 Indian companies among the top 10 global auto market cap gainers of 2022. As many as six Indian automobile stocks have made it to the list of top 10 global automakers based on their 2022 stock returns. Select domestic automakers were benefited by a pent-up demand and normalization of supply during the year after the disruption due to the COVID pandemic. Of the 46 auto companies worldwide with a market cap above $5 billion, only 12 were able to generate a positive stock return in 2022, and a half of these are Indian. According to the Bloomberg data, TVS Motor Company is ranked second with a stock return of 72%, following the 106% returns of Ford Automotive Sanayi, a Turkish unit of Ford which holds a 41% stake. Mahindra and Mahindra, that is M&M, and Autmkrs Motors ranked 4th and 5th with returns of 50% and 23% respectively. Traditional automakers made a comeback on the Bowsers in 2022 as marquee new age electric vehicle manufacturers failed to earn the returns. Market capitalization of the EV markers such as Tesla, Rivian Automotive, Xpeng, and NIO shrunk by 60 to 80% in 2022. Tesla's market capitalization dropped to $355 billion towards the end of 2022 after crossing $1 trillion in 2021. Globally, 5 major pure-play EV companies lost nearly $800 billion market cap from their peak valuations in November 2021. On the other hand, the electric vehicle projects of the Indian companies continued to attract investor attention. TVS Motor, for instance, was able to expand its EV product portfolio. Analysts expect 5 new EV launches by TVS in the next 12 to 15 months and an EV volume of 3 lakh in financial year 2025. M&M basically expects the EV's share in its sales volume to reach 20 to 30% by the financial year 2027. The company plans to invest 10,000 crore rupees over the next 7-8 years in the new EV facility at Pune, Maharashtra, to develop and produce born electric vehicles. The British International Investment Fund will invest 1,925 crore rupees in M&M's EV unit. Now, if we see the key statistical figures, we will be able to analyze that Ford Automotive Sanayi is the best auto stock globally as per 2022 return, which is valued at 106%, followed with TVS Motor at 73%. Then Mitsubishi Motors at 57%, Mahindra and Mahindra at 49%, Autmkrs Motors at 23%, Maruti Suzuki India at 13%, Bajaj Auto at 10%, Hero MotoCorp at 9%, then Changan 9%, Yamaha Motor at 8%, and Harley Davidson Inc. at 7%. So this is actually very, very encouraging, dear friends. Now, I would like to conclude this session here itself, and this was extremely thrilling for me to go through these core intricacies related to different aspects with a lot of diversity in our today's session. So dear friends, I hope that this extremely well analytical and well structured session would have helped you to gather very good insights, helping you to embrace and enlighten your knowledge set with eternal wisdom. Thank you so much. And I would be really grateful if you could please subscribe to my YouTube channel so that you get notified about the important economic updates on regular basis. And on this platform, we are trying our best to bring to your table the best and the best filtered out news which are of great prominence for enhancing your overall knowledge base and to enlighten the youth of the country, to actually strengthen them, to make them aware of the Indian economy, to make them aware of the core strengths we possess, to make them aware of the great talent we possess, because we are the future assets of this country. And we have to, as we had discussed in the beginning, a best way to lead is to deal with every situation very effectively. So we have to We have to be very, very updated. We have to be very, very thorough with the core economic concepts. We have to be able to deal with all the factors. Then only we can become great leaders. Then only we can lead in every situation of our life. So, thank you so much once again. Namaskar. Jai Hind.